Hello, everyone, and thank you very much for joining us today on the week's first webinar for the Ideas for Your ISA series. I'm Joseph Litchow from Kepler Trust Intelligence, and today we're going to be turning our attention to the world of global equities. And in just a moment, we'll be hearing from Richard Claude, Fund Manager of the Bankers Investment Trust. Now, before I hand over, a very quick word on the format for those who may be new to these kind of sessions. Richard will speak on the trust for 20 to 30 minutes, sharing an update on the trust itself, but also a perspective on the kind of current market backdrop. And after that, we'll leave some time at the end to move into a live Q&A session where we'll aim to cover as many questions as possible. So if you do have any burning questions now, or anything comes to mind during the presentation, whether it's trust specific or whether it's to do with the broader market environment, please do just drop your questions into the Q&A box on the bottom right hand of your screen, and we'll get to those at the end. So with that said, Richard, it's a pleasure to have you with us today. Over to you.
Brilliant. Well, thank you very much. And I know there's an awful lot going on in the world at the moment. So, a great time to, I think, to have a conversation. Please do take advantage of, asking those questions. And I'll spend a little bit of time first just laying out what we're trying to do with bankers, and then very much looking forward to answering those questions. So, I'll try and just take through. I know many of the people on this call will be shareholders, many maybe not so familiar with bankers. So I just want to spend a little bit of time, just laying out what we're trying to do, why we think global equity is a good place to be, and how we do it with bankers, managed by Janice Henderson. So in terms of what we're trying to do here, this is a capital appreciation plus. We provide a growing dividend over time that's going to grow above inflation, but we're trying to deliver double-digit returns over the long term by doing that mainly through capital appreciation. So again, that's a little bit different to maybe some of the more income oriented trusts out there, but we're not as growthy as some of the sort of Scottish peers that we have out there as well. We invest in globally in the broadest possible opportunity set in listed equities, and try and find a core portfolio of around 100 high quality companies that we think offer us some exciting stories, but more importantly deliver that profit and cash flow growth that we think can ultimately deliver that capital appreciation and also give us the income to be able to provide you with the income. We're benchmarked against the FTSE World Index. We're a pretty sizable trust. We're about 1.5 billion sterling net assets. We're pretty flexible in style, which I think is important, and I'll get into that in a bit more detail. But I would very much position bankers between a Scottish mortgage at the more sort of growth at any price, private SpaceX sort of end of the market, but not at the sort of value end of the market. And so I think we give a very nice balance of that sort of growth versus value. We're not sort of any particular style. We can provide both, which we think provides consistency over the long term, but also I think ultimately helps deliver that double-digit earnings and cash flow growth at a reasonable valuation. We think ultimately that's what's going to deliver consistent capital appreciation over time, as well as providing some nice income along the way. And we have grown that dividend in absolute terms for 59 years in a row. And we're very committed to keep doing that, plus with some pretty reasonable charges as well, particularly when you compare that to some of the open-ended funds out there. So you probably, many of you maybe have seen Alex Crook, my co-lead manager on Bankers. He's been managing this since 2003. So you would have seen him many times presenting on Bankers. So this is a bit new for me. So just maybe a little bit of background on me. Actually, I was hired straight out of university by Katie Potts at Herald Investment Trust. So started life in investment trust, and I feel like I've sort of almost come full circle, but in the intervening period, and still I'm actually one of the lead managers on our global technology leaders strategy. So running about 7 billion sterling in global technology. And I was brought in to be one of the lead managers on Bankers in September of last year. And I started taking over our US sleeve, which is the largest sleeve in Bankers at the end of October of last year. So I'm relatively new to this, but building on just that consistent journey that we've had, where we leverage some of the key managers at Janice Henderson to run regional sort of sleeves within Bankers. So Junichi there, who runs our Japanese sleeve, and Sat, that runs the Asian sleeve. But then also more importantly, and I think this has been part of the journey of Bankers, leveraging effectively the whole of Janice Henderson to deliver that portfolio of 100 sort of best ideas in global markets. So, we're a big asset manager. We've got some real expertise, both, regionally, as I kind of mentioned with Junichi or Asat, but also just from a sector point of view. So we're one of the biggest dedicated technology managers out there, managing the best part of over $20 billion in dedicated technology funds, as well as in healthcare and biotech, very strong, as well as global property. And again, we can take that regional sector expertise and bring those best ideas into bankers to deliver that global sort of very diversified portfolio. This is one of the longest standing trusts out there, but again, I think just for anyone who's less familiar with bankers, the name maybe insinuates this is a financials fund or something else. This is a global equities portfolio, nicely diversified. We'll go into a bit more into that. It's been around a very long time, and we see as a great way of getting exposure to global equities over the long term with a nice little bit of income on the side. So just to feed into a little bit, what we're exposed to. So this is truly global. So we've got exposure across the world. Again, we think that's the best way to harness key trends and innovation that we're seeing all around us. We'll get into a bit more about AI, but also just in terms of geopolitics and risk. We want to be diversified in terms of geography. You can see that on the left-hand side. But then again, I would always note that geography doesn't necessarily mean that the companies we're investing in are actually exposed to that geography. A good example of that is last year everyone was very excited about the Kospi or the Korean market. I sort of highlight that 35% of the Kospi is to Korean memory companies, and they're selling their chips into with NVIDIA chips into data centers, mainly in the United States. Not really got much to do with Korea. So again, it's really important to think about what that end company that you're investing in, not just where they're headquartered, but where are they actually selling to? Where are their end markets dependent on much more than just where that company is listed or headquartered. But again, the important thing is to have diversification, particularly given what's happening at the moment and some of those, it's a black swan and left field events that we can have. And then from a sector point of view, again, plenty of diversification. So, within that, we want to harness innovation in technology, but we also want to have some more defensive sectors in there, like healthcare or REITs or utilities. And again, we can provide that balance in there as well, and provide strong ideas from a variety of sectors rather than just being a technology trust like some of the ones out there in the market, or being overly focused in one area, or overly defensive or value orientated in just like some of that UK exposure where you're more exposed to telcos or banks or to materials and oil. Again, we want to have that broader exposure in the portfolio so we can genuinely give you a global footprint and exposure. We think again that's the best way that we're going to be able to deliver consistently double-digit earnings, profit, cash flow growth to ultimately deliver strong returns in that banker's share price for you. And that's the key for us to be global. We don't think geography is a lens of really being able to invest. Again, as I said, the bottom-up companies might have exposures to all sorts of different areas. They might sell luxury goods to China, or selling industrial equipment to China, or they might be selling pharmaceuticals to the United States. Just where their headquarters or list doesn't really tell you what the end market exposure is. And again, even if you kind of felt that you had exposure to strong GDP growth in one economy somewhere, again, there's no real correlation between GDP growth and the performance of stock markets in that country. So again, for us, it's all about that bottom-up stock picking to try and find great companies that we think can deliver double-digit growth, so well in advance of GDP growth globally. Where can we find those? And again, we've got the widest possible opportunity set to be able to find that with some of the experts that we have at Janus Henderson. We can truly capture those major trends and themes that we can all feel around us, whether that's AI, whether that's deglobalization, an aging population, geopolitics. We can really sort of harness that across the globe and be able to, again, find companies that can benefit from that. I know there are a lot of risks around what's going on in the world at the moment, but that also creates investment opportunities, and we want to be able to harness that to deliver that capital appreciation as well as that income growth. And just a little snapshot on the right-hand side of where are we actually taking bets. So not just our absolute positions, but where are we taking big bets versus our benchmark. And you can see I'll go into Amazon and some of the utilities like NextEra later. But RTX, unfortunately, in this world, we're very rapidly depleting missile stockpiles in terms of both offensive and defensive missiles, and those missiles, whether they be Tomahawks or Patriots, are made by Raytheon, which is part of RTX. So again, that's a company that, again, unfortunately, does benefit from the world that we're currently in, and all of those horrible sort of images and videos that we're seeing at the moment. But that company is aiming to double its Tomahawk capacity. And again, Trump was meeting with the CEO of that company just last week to try and push them to with more urgency ramp up that capacity, but also on the defensive side. And again, all of those drone interceptors or ballistic missile interceptors to be able to defend countries. Again, that's made by RTX as well. TSMC, I'm sure many of you are familiar with, but again, we think is a great play, obviously, on AI compute. But you'll see some of the banks there, whether that be Morgan Stanley, that gives you a bit more exposure to some of the investment banking and some of the, if we're going to have SpaceX IPOs or Anthropic or OpenAI IPOing, again, that could generate some significant fees for companies like a Morgan Stanley in a way that the UK banks don't benefit from that so much. But we still like UK banks like a NatWest, that again we think are still very, very cheap, even after a very nice move. Again, getting more surplus capital, which they can use for M&A, as we've seen recently, but also to return that to us as well. And then companies like Applied Materials. The reason why we like say a TSMC or Applied Materials is effectively post ChatGPT, the likes of Nvidia were able to grow so significantly by using excess capacity in the semiconductor industry from post the pandemic, when we all thought we were going to be working from home forever, and so the industry built a huge amount of capacity that then ended up with a massive amount of oversupply that was used up by the AI sort of ramp, but now we're effectively full. And so that's why TSMC is just committed to building significantly new fabs and capacity, as well as in the US, through the end of this decade, and that's leading to significantly more semiconductor equipment spending, which is a reason why we want to own a name like an Applied Materials. But you've got everything there, from Italian and UK banks to investment banks in the US, to defense companies, to semiconductor manufacturers in Taiwan, to Meta, to Amazon. You have the whole sort of swathe, and again, that's why we think it's important to be global, to truly capture these trends, and again, to have some differentiated exposures, and where we think that the most exciting growth opportunities are out there in the world. In terms of some of those trends and themes, just to give you an example of what we're looking at. So obviously I sit here with a lot of sort of technology expertise, and obviously I see those huge build outs of data centers. I just had my team out on the West Coast in Seattle, meeting with Amazon and Microsoft. Another one of my colleagues was just out in San Francisco at the Morgan Stanley conference, meeting Jensen Huang and Satya Nadella. And again, all of that data center build out is going to require a huge amount of power. And again, to harness that opportunity, let's think about that globally. Let's think across the entire supply chain. So, whether that be, grid based companies, or people making the electrical equipment or the power equipment in Europe, or actually the utilities themselves. So again, utilities are normally seen as being quite boring, but actually in the United States, in a lot of those states where they're building these data centers, that's putting a huge amount of pressure on the electricity pricing. And that's going into midterm elections at the end of this year. That's actually quite a topical and very sensitive voting issue. And so actually what you're seeing in a lot of the states, such as Florida, where NextEra are very involved and have a big kind of energy sort of, not just producing the power, but also just selling that to a lot of households in Florida. They're being able to actually bifurcate the market. And on the one hand, we're used to kind of these regulated returns. You're only allowed to charge so much, or increase prices so much. But actually, they're being allowed for these data center customers, the Amazons and Microsofts, to be able to charge them much higher pricing and keep that separate, and be able to make much higher prices, much higher returns on their capital, much higher margins. And that's encouraging them to build more capacity. So not only do you get faster growth, but you're getting faster growth at higher margins and higher return on invested capital, which again we like. So again, even in boring old utility land, we think there's some interesting plays we can take advantage of globally, as well as trying to take advantage on that equipment side and infrastructure side, from Hitachi in Japan back to Europe, into the UK, just given the strength of this trend that we see continuing for many years to come. So we can play these data center build outs not just through technology companies, but through the broader supply chain and enablers of that as well. And then, I don't think we could, really talk about, global investing without talking about AI, and especially with my technology hat on. I would just, I know there's been a huge amount of debate around AI. So recently we're just talking about whether we're in a bubble or not. I'm certainly, I've done this for 23 years as a technology investor. Just to give you my sort of 2 cents on this. effectively, in terms of what I'm hearing from, Anthropic and, OpenAI, as well as the big, listed tech companies, we effectively hit a bit of a mini ChatGPT moment at the end of last year with the launch of Anthropic's Opus. So we got to a point where effectively agentic coding, or an AI agent that does the coding, is now better than a human as of that release at the end of November. And that has very profound implications. So you will have heard the Spotify CEO say that basically since December, none of his software engineers do any coding anymore. They just supervise the agents doing the coding. Now, if AI is about coding new algorithms and new large language models, and then we've got new faster chips coming from NVIDIA and new TPUs coming from Google, we're going to get a much faster feedback loop that you can make, you code and program these large language models much faster. You can then iterate them much quicker and deliver them to us much quicker with much faster chips. And so the feedback loop and the flywheel just keeps getting faster and faster. So we're at a period of actually accelerating innovation in AI rather than some idea that, after 3 and a bit years, we would start slowing down. And that's why you're seeing the impact in the stock market. You're seeing just every day, it seemed before that this war, that, there was a new sector that we thought was going to be disrupted. It was the software and the SaaS apocalypse. But then it was, financials and banks and insurance companies and marketing, and, every other sector was being disrupted. And that's because we really do think we're at the precipice or the start of this agentic AI world, which is going to be very disruptive to white collar work in the way that sort of automation was to blue collar work over the last sort of 50 or 60 years. And it's going to happen in a pretty compressed time period. Now, from an investment point of view, obviously you want to harness the key beneficiaries of that, from the technology side in terms of, who's winning there, and enabling that, in terms of the actual large language models, whether it's an Anthropic when they list probably later this year, or an Alphabet that did very well last year, the enablers of that and the supply chain, through the chips, through the data centers, through the power infrastructure. But then also, I think on the other side, as we think of global investors, we want to, avoid the areas that are genuinely going to be disrupted. Now, at the moment, there's a lot of baby out with the bathwater, and someone launches an agent, and suddenly, that sector is going to get killed, particularly in the US, where a lot of people trade, ETFs and baskets. But actually, when we talk to the analysts here who have known these industries very well, talking to me and to my team about, what Anthropic's saying, what OpenAI is saying, can we put two and two together to figure out which areas are genuinely going to get disrupted by AI and we really want to avoid, and which are the areas we want to invest in because actually they're not going to get disrupted. And this is so important because I've done this for the best part of a quarter of a century. Not much else you needed to get right in the last quarter of a century than realize that the internet was real and that the FANG were going to be the winners, and you wanted to avoid high street retailers and traditional media. If you'd done that, you would have done pretty well in global equities and generated some pretty nice returns and massively outperformed over the last 20, 25 years. We've effectively got to try and do the same thing through the next decade to harness great returns for you and avoid some of those disrupted areas and those risky areas. And the challenge and the reason why I think you need some specialism and expertise is, I remember 20, 25 years ago being told by every high street retailer and every company that came in that they were going to be beneficiaries of the internet. And in many cases, obviously, they were not only not beneficiaries, but they were actually severely disrupted and losers from a new technology, because unfortunately every new technology comes with opportunities, but it also comes quid pro quo with a lot more new competition. So, in theory, high street retailers could have used the internet to sell a lot more and have much higher growth rates. But unfortunately, it enabled people like Amazon to come in and disrupt them. And the same with traditional media. Again, it enabled people like Google or Facebook to come in and dominate advertising, enabled people like Netflix or Spotify to come in and disrupt, music and TV. And again, we'll see something similar in AI. Every company comes to meet you today and tells you they're going to benefit from AI. In many cases, they will, but in many cases, they won't, because there'll be new companies that come in and disrupt them. And again, we're trying to sort of harness that, as well as, some of again, some inflection moments we're seeing on the physical AI side in terms of robotics, humanoids. You saw the dancing humanoids in the Chinese New Year gala, but also robo taxis. So again, we're going to see Waymo launch in many more US cities through this year and into next year, and also probably in London this year as well, along with Wave. So we're going to see robo taxis come to the streets of the UK this year, as well as in Tokyo, as well as in the Middle East and in Europe. So we're at a point of I think significant acceleration in AI, in innovation, and that should create new opportunities for us to invest and harness those growth opportunities in this portfolio while avoiding some of those more disrupted areas. I often, again, when we get sort of shown the charts of, that we've got more exposure to the US or more exposure to technology, or they see some of the big tech companies we own in our portfolio, I often get pushback as to, well, God, well, the US is really expensive and technology is really expensive and some of these big tech companies are really expensive. I would just warn people just to say, just look at the numbers yourself. Be careful with averages, because if you have an average of 7 companies like the Mag 7 and one of those companies trades on 154 times PE, then that's quite distorting to an average of 7 stocks. Actually, if you look at many of the other names, we would argue in many cases they're actually reasonably valued, if not in some cases actually quite cheap. I think it's extraordinary that Amazon would trade at half the valuation of Walmart, given we think that they have a very strong e-commerce business and retailing business, as well as being very well positioned on the cloud side with AWS, and actually their recent deal with OpenAI really positions themselves to be the leaders in agentic sort of commerce in the future. We would also argue that even a name like an Nvidia, where again people always tell me Nvidia is so expensive. Nvidia is trading at a discount to McDonald's. So again, we would argue that people very much are saying that this isn't sustainable, which is very different to an AI bubble when everyone just thinks that this is going to go on forever. So again, we think that there's some fairly reasonable valuations out there, and you'll notice the 3 companies that we have significant weights in and significant overweights in, Amazon, Meta, Nvidia, are the 3 cheaper tech companies, Mag 7 companies out there. So again, that's where we're just trying to provide a little bit of reasonable sort of rational valuation discipline around some of the names we own. So provide some really innovative companies, and the innovation that comes out of Nvidia is extraordinary, but we don't want to overpay for that. Again, we're investing in stocks, not in technology or innovation. And for a stock to work, we think it needs to be reasonably valued. So again, that's what we're trying to provide in bankers. The other thing, to say is that, I know that, the world seems an incredibly volatile place at the moment. I've done this long enough, and I'm sure many of you have been investing yourselves for long enough to know that, there's always something going on. Unfortunately, last year we had Liberation Day, not long before that we had COVID. The GFC wasn't that long ago. There's always something going on. And it always seems like the easiest thing to do is worry and not have your money in the market. We would sort of highlight, this chart sort of slightly arbitrarily goes back to 1989. But over that very, very extended period, if you just kept your money in bankers, you would have returned 3,763% and done a nice 10% annualized over the very, very long term. And as I said, how do we do that? We do that by delivering 10% sort of earnings and profit growth over the long term, and having a little bit of dividend yield on top of that. You can see on the right hand side, that's our sort of dividend growth versus CPI. And again, we've been just aiming to deliver around that or marginally ahead of that over time. And as a result, in absolute terms, we've grown that dividend 59 years in a row. We think that's important. We don't want to be a big kind of income trust, because we think that just really undermines your ability to deliver the capital appreciation. You skew to value, you skew to income. It limits the stocks that you can own, because you can't harness much of that sort of growth and innovation, because they might not pay dividends, even if actually many more technology companies do pay dividends these days. But we want to have as much freedom as possible. But I think it's important to pressure our companies to pay dividends, because I think it provides some discipline to them. And then I think it provides some discipline to us as investors to have to provide dividends to you. So again, I think that just keeps us, investing in more reasonable bits and parts of the market where they have that growth potential, but also more reasonable valuations. We're not investing in private companies. I'm not adverse to investing in the odd private company. We meet all of them, given my sort of technology hat and my technology team. But again, we don't want to have 30% of the portfolio in private companies. Again, I've done this long enough to know that can be a problem in periods of market drawdowns and significant stress, as I've seen even in my career several times. So we think that this is the right balance, as I said, of providing good growth opportunities, but at a reasonable valuation. You're not having to go into major bits of the private world and paying ridiculous valuations for a SpaceX or those sort of names. We can do that in a balanced way, but still provide that exciting trends in innovation and growth, versus some of our more value orientated or UK orientated peers here. So again, we would like to think that bankers very much sits in the middle of that. So for us, yes, probably the why now and the case and the concerns for investing in global equity seem to be changing day by day. But for us, just given the trends that we're seeing, if you want to beat cash and you want to beat inflation over the long term, global equities is really proven over the very, very long term to be one of those, asset classes that really can deliver consistently over the long term. And as I showed you that chart, being able to do 10% compounded over decades, we really do think that's a good place to be. You do want to be balanced within that. There are times when super growth works, like back in 2020. There's been times, but it's been a little while until more recently that values worked. You want to have a balance between the two, and that's what we do in terms of the managers that run this portfolio. Even if you think about between me, who's a bit more growth orientated, and Alex, that's a bit more value orientated, and then you throw Junichi and Sad in there. But I think in Janus Henderson generally we've got a bit of a balance there, and that's really trying to deliver what we're trying to do with bankers, which is to provide that sort of consistent return over time, both in terms of capital appreciation and that income growing over the long term. You can't do that if you're just a pure growth manager, a pure value, or you're just focused on one market or in one sector. You've got to have that diversification. I think that's what we provide there to give you your kind of core exposure to global equities, which we think is a great way to find that long-term capital appreciation. So, I'll leave it there, and very happy to take some questions for the rest of the session, and answer anything that's on your mind at the moment.
Brilliant, fantastic. Thank you, Richard. I think that was a really good update on both the trust, but also some pockets and themes that are going on in the broader kind of market backdrop. I think it's really, really, really interesting. But let's move straight into some of the questions. I think that's always the fun bit. AI, as you mentioned, has been such a big theme, such a driver of returns in recent years. But then there's also been a growing debate and growing evidence, really, that it's a source of concentration risk. A handful of stocks in the US, there's a handful of stocks in emerging markets, that seem to tie themselves together and dominate a space. So from your view, and I guess for a longer term investor's perspective, where do you see the most compelling AI opportunities? And equally, what are the risks that you and the team are kind of most conscious of?
Yeah, and I think, in contrast to say 2000, we're having a really rational debate around this. I mean, I think fairly consistently through the last 3 years, there's been this debate that, this AI capex is too big and it's not sustainable, and where's the monetization, where the return on investment is. I would, really point people to look at, a few things that, we've been looking at recently. I gave you the technology update, but, the other thing is, I've never seen in my technology career, and I've seen some pretty extraordinary companies through the last couple of decades, a revenue ramp like what Anthropic has just shown us. So, Anthropic was annualizing at $9 billion of revenue at the end of last year. They gave an update in the middle of February that they got to 14, and they just told us they've got to basically almost 20. I've never seen anything like that in terms of the growth rate and also just the scale. I mean, again, just adding billions of dollars of revenue is not easy. Now, that's revenue, that's not profits. But again, when they look to IPO later this year, and in our conversations with them, they're going to show us a pathway to profitability and a positive, sort of cash flows. Probably, it was meant to be 2028. I just given the inflection in the business, probably something a bit earlier than that, and even on OpenAI. So, I think, we've been very laser focused on ultimately the end customers that are giving the money to the hyperscalers, that are giving the money to NVIDIA. Yes, we can be concerned about circular financing, and all that, but at the end of the day, the end customers need to make money and they need to be self-sustaining. That's what's going to make this all sort of viable. Now, to do that, they've got to give us technology that we all want to use and actually have some value and is productive for us. I think that they're certainly delivering that. They then got to show that they can monetize that, and again, I think they're starting to show that. So, again, I think that gives us opportunities across the whole spectrum. I very much use a framework like the internet. The first thing you do with the internet is you have to build infrastructure. So, the problem with 2000 was we had a dial-up broadband and a Nokia feature phone. And then we had to build fiber broadband. We had to build 3G, 4G, 5G networks, and you had to give everyone an iPhone. So we're seeing that with AI, we're building out the infrastructure. So I think there's opportunities there. Then you have a platform, that was the App Store and Android. I think in this AI world, it's the hyperscalers, the cloud, we're seeing an acceleration of cloud adoption. And then ultimately, then you get the applications and the services. Uber was only founded in 2009, so 2 years after the launch of an iPhone, because without an iPhone and apps, you couldn't have ride hailing. TikTok wasn't founded until 2016, so 9 years after the launch of the iPhone. So again, I think they'll give us a very long dated opportunity set in some of these areas and some new IPOs. So I think there's a very broad spectrum of investment to be made. You want to pick a few of the mega caps, and then there's probably also some interesting opportunities across the whole spectrum, and that's how we're sort of approaching this opportunity.
Brilliant. And I guess staying perhaps less specific to AI, but on the technology theme, we just had a question come through, Richard, on quantum computing, and it'd be interesting to get your thoughts on that and how you and the team at Bankers would play that theme.
Yeah, so something that a technology that's incredibly interesting. We spend an awful lot of time, talking to companies from startups all the way up to the Googles and Microsofts that are very involved in that space as well. And I think an important distinction to make is, we're investors, not technologists or futurologists. So the difference is that we're investing in a company. If they're not meaningfully going to make more money from that new technology in the next kind of max 3 to 5 years, that's the difference between being an investor and a futurologist. And so, basically, if any company and I come out of that meeting and think realistically that technology is not ready for kind of prime time for at least 5 years plus, then that's not in the investment horizon for me or my team or any other Janus Henderson investor that's feeding into this. And that's where quantum would be at the moment. I mean, I think there's some good progress that means that we're on a more. I think there's more conviction that we're on a pathway to something. But when that something is going to be and what that something is, I think is still, still at least 5 years plus away. And the evidence I would provide for that is that, in terms of, the technology itself, there's so many different paths still being pursued to get there. No one's really agreed on kind of one or two ways that we're actually going to get there. And the companies that tell you it's going to happen the soonest are the companies that need to raise money. And the more sensible people that don't need to raise money will tell you it's probably at least 5 years plus until we can get something that works, well enough, let alone going into sort of more of a mainstream sort of adoption. And we also think quantum will ultimately be delivered through the hyperscalers, the cloud guys, and because actually you need a huge amount of traditional compute to make quantum compute work. And so they kind of need to go side by side, and the most natural place for them to go side by side is in an Amazon or a Microsoft or a Google or a GCP.
Interesting. Very interesting. And I guess technology and AI as a theme or as a structural trend potential, it seems to kind of dominate a lot of the conversation, right? But outside of that theme, it'd be really interesting, Richard, if you or the team see any other themes or structural trends that are offering quite either early stages of value or those kind of multi-year long-term growth potentials as well. And it can be either regional sector, but just outside of the kind of main hot topic themes, it would be interesting to see if you see value elsewhere.
Sure. So, I mean, a couple of things to pull out of that. I mean, actually, staying on the AI side, our framework, we're trying to find companies that are genuinely going to benefit from AI, outside of the traditional technology areas. Actually, one of the areas we would throw out is banks. And the reason, what we're looking for is that, as I said, new technologies bring great opportunity, and so the ability to cut cost and generate more revenue, but they bring more competition. Now, a lot of people have said, "Oh, you actually your competitive moat against AI is proprietary data." In a world of generative AI, am a lot more, I'm a lot less sort of convicted in that because I just think you can create a huge amount of synthetic data these days. And so actually what we're looking for is, distribution and network effects, and or regulation, or licensing. So actually, two of the areas that, we think are quite interesting are banks because you're a white collar work. You can really automate a lot of that and have a lot more productivity and grow a lot faster, have a lot more customers without necessarily having to hire significantly more people. But you've got the protection of regulation, which means that you're not going to have a startup sort of AI bank providing you agentic AI banking, all coming through the door tomorrow because they're going to have to get that banking license. And the same for say, a Spotify or a Netflix. Again, we saw everyone was playing around with Sea Dance over Chinese New Year, but the problem is a lot of that IP was copyrighted and was Hollywood. So Hollywood sent those cease and desist letters pretty quickly. We think the people who are best placed to actually be able to take AI tools so that you can create really exciting new things to listen to or to watch will be the likes of a Spotify or Netflix because they already have those licensing deals with Hollywood or with the music labels. So we think there's an interesting sort of opportunities there when actually many of those actually been in the AI loser camp, in terms of market perception. And then beyond that, I think what's happening, unfortunately, at the moment only plays into our, sort of deglobalization trend. We had 50, 60 years of globalization, post, sort of China coming into WTO as sort of the poster child for that. And, for various reasons, we're going the other way. And that just means that supply chains are getting more complex. They're having to be built regionally, not just outsource everything to China. When you build them regionally, you're often having to build them in more high cost locations. And that means that, you're building new factories, which normally means you adopt new automation and industrial equipment and technology and AI. But also, that just, that return just becomes more compelling when you're thinking about, the labor costing so much more. I remember talking to one of the contract manufacturers that we own, Jabil, and they were saying, cost comparison between Mexico and the US is $33 for a Texan worker all in with health benefits, versus, 6 or 5 or 6 in
Mhm.
Mexico. So again, the way that you're going to, offset that or increase the productivity of that worker in Texas is to have a huge amount more automation. And that's where we're seeing, Amazon are actually, got a Project Vulcan this year, which is a lot more intelligent robot that they're rolling out in all of their warehouses globally starting from this year. Again, we think that can generate a huge amount more efficiency. But again, these building out of these regional supply chains, much more complex supply chains, gives us a lot of opportunity to invest from REITs and from the property itself in terms of people who actually own those warehouses and logistics centers to actually what's going in those logistics and warehouses and factories.
And I guess a lot of opportunity, a lot of value elsewhere, like you said, that you're able to find not just within the AI, but supporting AI and broader. But no matter what theme or opportunity that you kind of come across, it's always going to be exposed to some uncertainty, particularly around geopolitics. And I know you've alluded to that throughout the presentation, but for you and the team, I guess, how do you go about thinking about geopolitical risk, and particularly when it comes to building a portfolio, allocating capital, recycling capital, and just managing that risk, because there's so much of it is changing so frequently. It would be really good to understand that process, but then also where you see perhaps some investors overestimating the risks and the opportunities that have been brought to light by those geopolitical tensions.
Yeah, absolutely. So, I think it's important to have balance, and I think it's also important to have, investors that are, focused on their areas, not just generalists, but, really understand not just, I think the industries that they invest in, the stocks they invest in, but also, the sentiment and positioning around those areas. So, no one came into this year feeling any goodness around oil. And everyone just thought oil was absolutely terrible. Actually, we had a pretty big overweight in Chevron coming into this year. Now, I'll say that was mainly on a sort of cash flow return story, and then you had Venezuela, and then you've had what's happening in the Middle East today. But again, that's played quite well for us. We own a company called TC Energy, which is a natural gas pipeline in the United States. We've had more broadly this halo trade, these sort of hard assets with less obsolescence, but we've owned two of the big US railroads, where again they're not being replaced by AI anytime soon. We talked about some of the utilities before, so it's just by having that balance in the portfolio, because I always remind people that the market is a forward discounter. So anything that we're worried about, the market does discount pretty quickly. The things that get you are the unknown unknowns, the things that come out of left field and really hit markets hard. And your best defense against that is, I would argue a couple of things, diversification for a start, and then
Mhm.
also, buying companies that are profitable, have strong balance sheets, and are reasonably valued. You're just going to take less pain, versus, if you're in kind of areas that are, ridiculously highly valued or super small cap and illiquid. You're just taking on additional layers of risk, that we feel we take less of in bankers. And again, that's why we think we're good sort of core allocation in global equities. And we give a good balance between the two. But geopolitics, the media always focus on the risks. We would
Mm.
say yes, there are risks, and we want to mitigate those. But it also creates opportunities, and again, can we harness those as well?
I guess for the trust, and you've alluded to this already, there's a big focus on that capital appreciation over the long term, but also that consecutive record of income and growing a dividend over almost 6 decades, which is a very impressive feat given what's been happening over that time period in markets. So it'd be really interesting, Richard, if you could maybe talk through some of the opportunities you're seeing for income. I know it's not income focused and income led, but we're hearing a lot of conversation about evolving dividend cultures, particularly further east in eastern markets. So it'd be really, really good to get an idea on where you're seeing areas that have really stepped up in terms of income over the last few years.
Sure, and I'll maybe put that into a sort of a slightly wider sort of question, which is, I'd like people to go away from this, especially people who are less familiar with bankers, with the sense that things are changing at bankers. Bankers have been around since 1888, and we wouldn't have survived that long if we didn't evolve over time. And there has been an evolution in the last few years. People who've been shareholders and bankers will know this. We've moved a little bit more balanced in that sort of growth versus capital growth versus income, a little bit more balanced in that growth versus value. We've brought down the number of stocks. We've kind of harmonized that portfolio a little bit more so that they're not just separate regional sleeves, but they're talking to each other a lot more. There's a lot more sort of coherence in that portfolio. And we've also looked inwardly, as part of me coming on board, part of those conversations we have with the board. We had a new chairman come in, a few years ago. So again, there's been this conversations about what do we want to be? And we could have gone, some of the other trusts have gone, let's pay 6 or 7% income, and there's various ways you can do that, just in terms of the investments you're making, or from a synthetic point of view. And we've taken the view that actually, in terms of our end outcome to you as shareholders, the best outcome we can provide you to reach your financial goals is to have a balance and not to go too income oriented, because that just limits too much of your investment opportunity set. So we want to have that balance between the two. So that's the first decision we wanted to take. And then when we think about that globally, I think historically we kind of do that more from a sleeve point of view. So our US sleeve manager would have to, still deliver, 2-3%, dividend yield within his portfolio, and that's just harder to do in the US. And I think now we just look at that from a much more kind of global perspective, in that, if it's easier and there's some better opportunities to get better yield and income in Asia, let's lean a bit more into that over there, and then we can lean a bit more into the growth opportunity over it, say in the US, and then balance that out. We've also got capital reserves that been revenue reserves that have been built up for many years, exactly for this sort of opportunity where we see a bit more of a growth opportunity. We can pay out a little bit more out of those revenue reserves to pay out the dividend, which again, we've got plenty of coverage for years to come. And then to your point, we're seeing dividends used to be a very dirty word, particularly in the growth, particularly in tech. If you were paying dividends as a tech company, you were effectively admitting you were mature, ex-growth, or even legacy. And that that mindset's really changed in terms of even a Meta or Google would be paying dividends. But if you look at the tech sector, that used to be mainly in sort of semiconductor areas, or in more legacy tech, like a Cisco. And now we're seeing that some of the internet companies and some of these other companies are paying dividends, and even a company like Nvidia, they're probably going to be doing best part of $200 billion in free cash flow this year. So yes, the majority of that's probably going on buybacks and doing a bit of M&A, but again, they have a dividend, and there's the ability for that to grow significantly over time. So that's certainly something we've been pushing these companies to do, that within a balanced sort of use of that capital. Yes, you can go and invest in an OpenAI or an Anthropic. Yes, we can do some buybacks, but also maybe you could increase your dividend over time. And we've seen that with, say, a Broadcom, that is committed to paying 50% of their free cash flow out as a dividend. So I think it's evolving in a good way, and certainly we think that it'll be much easier for us to pay to have that CPA plus dividend growth in the portfolio while still maintaining that balance between growth and income in years to come. I think that'll be easier, and in the near term, as we just kind of bridge through that, we're happy to pay a little bit extra out of our reserves.
Brilliant. And I guess you've kind of delved in a little bit on valuations, particularly look at the individuals on a valuation ground rather than kind of using aggregates, which sometimes can be skewed. But it's clear that there are pockets of valuation that are both attractive relative to other markets like the US, or just versus their own history. So with that, Richard, it would be good to get your thoughts on gearing, how you and the team approach gearing, and whether you see those valuations as a good reason to think, we can really up the gearing now to kind of take advantage of those low levels, or if you approach it in a different way, and why, gearing's the level it is at the moment.
Exactly, and I think gearing, one of the great advantages of running a trust, and I think a couple of things go into that. I mean, we're about around 6% gearing at the moment, which shows that we're generally positive, but not kind of the full glass at the moment. We're sort of a little bit sort of half glass sort of full. So we want to lean into that opportunity, but not still having a little bit of dry powder that for maybe environments like this or dislocations like this. And the other factor is just kind of how you fund that gearing. So, we've got some sort of longer term funding for that gearing, but then we took some of the short term sort of, bank sort of loan off, because obviously interest rates were just a lot higher. Now interest rates are coming down, we can start borrowing, maybe back with a sort of a 4, a number in front of it, while before, it was sort of, 6-7%, potentially, which was a little bit high for us to want to use that. So, again, I think just in terms of kind of where interest rates are going, plus, just having a bit of firepower left for those dislocations, means that we can lean into the gearing potentially a bit more in the years to come. But it's a great resource to have, and again, we think enhances returns over the long term.
Brilliant. And there's a couple of questions on a few stock specifics in the trust, and I know one of the funds, one of the stocks, sorry, you do hold, which is Spotify. So it would be good just to kind of get an idea, get a flavour on your thoughts as what you see as an option and a long-term stock, long-term potential of that stock. That would be really interesting. And another that has come alongside it is Netflix. Do you own that? And if not, why?
Sure. So we own both, and starting with Spotify, we think that they effectively won the sort of music streaming wars, and now the debate is around the potential for AI opportunities versus disruption. And as I kind of saying before, we think that they were very much put in the wrong camp in that they're new companies like a Sonos where you can kind of vibe code content and music to listen to. But the challenge with that, I think is twofold. When we talked about distribution being so important in AI before, we learned this very quickly last year, but in terms of Alphabet versus OpenAI, if you already use some of these apps and already have them and already comfortable with them, if they offer you the latest and greatest AI as good as any new startup, why would you bother, moving over? It's much harder for that new entrant to get, your mind share, to get you to download that app, to engage with that app, to use that app. And the other, challenge is obviously you've got to do that legally, and you've got to have, the IP licensing. And again, Spotify's got all of that as does as the Netflix. So we think that, they've got the distribution, they've got your personal history of what you've listened to, and then they've got the licensing, which means that they can, put in, AI capabilities and charge you more for it. So, they've already been taking up the pricing. They've got an event later in the first half where again I think they're going to lay out that AI offering and what they're going to be able to monetize for it. And again, I think that people will give more comfort in terms of their future profit and cash flow growth, but also just maybe a potential re-rating that they're seen as being less at risk from AI. And the same with Netflix, although obviously you've had the overlay of the Warner Brothers deal. Now, I think if they'd managed to get Warner Brothers, that would have just been game over in terms of content. But again, good that they've shown a little bit of financial discipline. I think that the price that Paramount had to pay means that they then want to get some payback on that. They're going to have to license that content out to Netflix, so they get the access to the content anyway. It won't be exclusive, but probably just because of antitrust, it probably wouldn't have been exclusive anyway. So they get access to the content. They've got a huge amount of firepower and free cash flow generation coming through, so they can buy a significant amount of the stock back if they're not going to be allowed to do these sort of M&A deals, plus continue to take pricing up. The one area that we want to see a little bit more on is there is this shift away from long form video content watching to short form. Now, I would argue a lot of that's just multi-screening, so people are watching something on Netflix while also watching something on their phone. But I think Netflix have to show that they can keep people engaged. And I think part of that is going to be a little bit what we were talking about with Sea Dance earlier, that again, with sort of more licensed sort of content, can they do some quite interesting things on the engagement point of view to kind of take characters that we know and love and storylines that we know and love and mash them up into something a bit more short form that's quite sort of interesting, that keeps us engaged while also watching the sort of the long form. So we think that they're well placed to be able to do that. And again, just given what's happened to the share price, again, the valuation has come way down. Plus, because they've got a set amount that they spend on original content, they generate a huge amount of free cash flow as they kind of build, and grow on top of that. So, again, we think it's an interesting stock, just not in terms of their AI positioning, but also just in terms of their valuation at the moment.
Fantastic. Oh, Richard, that's been great, I think, and perfect timing almost. I think we've wrapped up everything we need to and covered all the questions that we can. So I think that's been a really, really insightful update, not only on the trust, but also where you and the team are seeing pockets of value and how you're weighing up kind of the broader risk, particularly on the geopolitical front. So thank you very, very much for going over that with us. For those left on the call that would like a bit more detail on the trust or explore a bit more about the team behind it, Richard and the guys at Janus Henderson publish a really good range of materials on their website, both trust-specific updates, but also broader market insights. So I'd really encourage you guys to go and give that a look. And another thing before we wrap up is just a big thank you, really, for joining us today on the webinar. It's been great to have you all, and those who submitted questions that were very thoughtful, very insightful. So thank you very much for that. And of course, Richard, thank you very much for sharing your insights on those. I think it's been a really, really good update on the trust, and a pleasure to have you on today's webinar.
Thank you, everyone. Thanks,
No
Joe.
problem. No problem. And I guess that brings us, to the end of today's session, and we do hope many of you will be able to join us for the rest of the webinars in the series over the coming weeks. So with that, thanks again for being with us today. Take care and goodbye for now.